Listen carefully. Margaret Holloway is 71 years old. She lives in a quiet brick ranch on the edge of Dayton, Ohio. The kind of house with a screened porch, a faded American flag by the mailbox, and an apple tree out back that her husband Frank planted the summer their daughter was born. It is a Tuesday morning in October. The coffee is cold. The casserole dishes from the funeral are still stacked on the counter, washed but not put away. Frank has been gone exactly 9 months. 9 months to the day. Margaret is sitting at the kitchen table in her reading glasses, the yellow legal pad Frank used to scribble grocery lists still sitting where he left it. In front of her is a certified letter, white envelope, blue ink, 3 letters in the return address that make her stomach drop. IRS. She opens it with shaking hands. She reads it twice, then a third time because the number on the page cannot possibly be real. The IRS is telling her she owes over $240,000 in federal income tax, on money she and Frank already paid taxes on money that was supposed to be their retirement, on the account Frank told her, promised her, would take care of her for the rest of her life. Picture this, a 71-year-old widow, alone in her kitchen, holding a tax bill that will erase more than half of everything her husband worked 43 years to build. And here is the part that should make you furious. Margaret did nothing wrong. Frank did nothing wrong. They paid their taxes every year. They saved. They were disciplined. They did exactly what every retirement book, every financial advisor, every employer told them to do. They put the money in the 401k. That is the account. That is the trap. That is the crime scene. Because the moment Frank's heart stopped in that hospital parking lot back in January, a 9-month countdown started ticking in the basement of the Internal Revenue Service. A countdown Margaret never knew existed. A countdown her CPA never warned her about. A countdown that is now about to take 60% of the largest asset her family owns. And here is what nobody told Margaret. Nobody told you either. There is one specific account in your household right now, yes, yours, that you must empty, drain, or convert before your spouse dies. Not after. Before. Because the day the funeral ends, the tax code stops protecting you and starts hunting you. And in the next 10 minutes, I am going to show you exactly which account it is, exactly how the trap works, and exactly how to defuse it before the certified letter arrives at your kitchen table too. Stay with me. This one is going to save somebody's life. Here is the part they hide. What happened to Margaret has a name. It is called the widow penalty. And it is not a glitch in the tax code. It is not a mistake. It is not an oversight. It is a feature, not a bug. The United States tax system is engineered, deliberately engineered, to take a financial sledgehammer to the surviving spouse the moment the first one dies. This should make you furious. Because nobody warns you. Not your employer, not your 401k plan administrator, not the financial advisor who has been collecting fees from you for 20 years, not the CPA who files your return every April, not the lawyer who drew up your basic will. Nobody. The system is counting on your confusion. The system is counting on your grief. The system is counting on the fact that in the 9 months after your spouse dies, you will be too broken, too exhausted, and too overwhelmed to read the fine print. And in that window, that 9-month window, the IRS quietly flips 3 switches that turn a comfortable middle-class retirement into a financial bloodbath. Who is the villain here? Let me name them out loud. The IRS, which rewrote the rules so that the day your spouse dies, you stop being a married couple and start being a single filer with half the protection and double the tax rate. The Congress that passed the Secure Act and accelerated forced withdrawals on inherited retirement accounts. The Medicare system, which then piles IRMAA surcharges on top, raising your premiums right when your income drops. And the entire financial services industry, which has every incentive to sell you the 401k, and zero incentive to warn you what happens when one of you dies. You were disciplined. You were responsible. You did everything right. You raised the kids, paid off the house, maxed out the retirement plan, and skipped vacations so the account could grow. And the reward the system has prepared for you, the reward waiting at the end of the road, is a 60% ambush on the surviving spouse. If that makes your blood boil, do 3 things right now. Smash the like button. I am not asking, I am telling you. Every like pushes this warning to another retiree before the funeral, not after. Hit subscribe. Flip the bell to all notifications. Because the next certified letter the IRS sends might be coming to your kitchen table, and you need to be on this channel before it does. Now let me show you the exact numbers. because once you see the math, you will never look at your 401k the same way again. Picture this, January 14th, the day before Frank Holloway had his heart attack in that hospital parking lot. Let me show you exactly what the Holloway household balance sheet looked like. Frank, age 73. Margaret, age 71. Married 51 years. Filing jointly. Social Security combined, $48,000 a year. Frank's pension from the auto plant, $22,000 a year. Required minimum distribution from Frank's 401k, $46,000 that year. Margaret's small IRARMD, $9,000. Total household income, $125,000. The 401k balance the morning of January 14th, $940,000. The house, paid off, worth $320,000. A small brokerage account, $80,000. Checking and savings, $42,000. On January 14th, the Holloways were comfortable. Not rich, comfortable. Their federal tax bill that year was going to be roughly $12,000. They were in the 12% bracket. They had a married filing jointly standard deduction of $30,700. IRMA Medicare surcharges? Zero. Life was steady. Now watch what happens at 6:42 a.m. on January 15th when Frank's heart stops. Listen carefully, because this is where the trap detonates. The instant Frank dies, three things happen automatically. Margaret does not sign anything. Margaret does not file anything. The tax code does it to her, silently, in the background, while she is still on the phone with the funeral home. Switch number 1, Margaret's filing status. She gets to file jointly for the year Frank died. That is it. The very next tax year, the one starting January 1st, she is a single filer. Not a widow with special protection, a single filer. Period. Switch number 2. Her standard deduction collapses from $30,700 to $15,700. Cut in half. Gone. $15,000 of income that used to be tax-free is now fully taxable. Switch number 3. The tax brackets compress. The 12% bracket for a single filer ends at $48,000. The 22% bracket eats everything from there to $103,000, then $24,000, then $32,000. Now layer the income on top. Margaret still gets Social Security, but only her larger benefit, because Frank's smaller check disappears. She loses about $18,000 a year in household Social Security. She still gets Frank's pension, but as a survivor, it drops to 50%, $11,000 instead of $22,000. She loses another $11,000, so her income falls by $29,000 a year. She is poorer. But here is where it gets ugly. Frank's 401k, that $940,000 account, rolls over into Margaret's name as an inherited spousal IRA, and now Margaret is the sole owner of nearly $1 million in pre-tax retirement money, every dollar of it taxable when withdrawn. The RMD on that account, combined with her own IRA, jumps to over $65,000 a year. Add her pension survivor benefit, her Social Security, the brokerage dividends, and Margaret's taxable income on a single return is now $98,000. Same household, less actual money in her pocket, but her tax bill triples. Her federal tax bill goes from $12,000 to roughly $19,000 the first full year. Then it climbs every single year as the RMD grows and the 401k keeps spitting out forced withdrawals at single filer rates. And that is only the first layer, because we have not even talked about IRMA, the 9-month estate tax window, or the bracket detonation waiting in year 10. Now we get to the mechanism nobody explains. Listen carefully. The widow tax trap is not one weapon. It is 5 blades. 5 separate cuts that hit the surviving spouse in sequence, each one deeper than the last. Most retirees never see blade 1 coming. By the time they feel blade 5, the money is already gone. Let me walk you through every blade, slowly, clearly, so you can never be ambushed. Blade 1. The filing status collapse. The year your spouse dies, you still file jointly. The year after, you become a single filer. That is the cliff. For a single filer in 2025, the 22% bracket starts at just over $48,000. For a married couple, it does not start until $97,000. Same income, same household, double the tax rate on the second half of it. This is the trap. The IRS does not announce it. It just happens. Blade 2. The standard deduction cut in half. Married couples in 2025 get a standard deduction of $30,700. Single filers get $15,700. The moment you become a single filer, $15,000 of income that used to be sheltered is suddenly fully taxable. And if you are over 65, the extra deduction shrinks too. You lose protection right when you need it most. This is not a glitch. This is engineered. Blade 3. The RMD Crossfire. Here is where the 401k becomes the murder weapon. When your spouse dies, their pre-tax retirement accounts, the 401k, the traditional IRA, the 403b, roll over into your name. You now own all of it. Every required minimum distribution that used to be split between two people is now stacked on one tax return. One single tax return. At single filer rates. A couple with $1 million in combined IRAs at age 73 is pulling out roughly $38,000 in RMDs across two returns. After death, that same $38,000 lands on one return. Then it grows, every year, because RMDs compound as you age. By age 80, the forced withdrawal percentage climbs above 5%. By 85, it is over 6.5%. The IRS is not your friend. The IRS designed this so that the longer you live alone, the more they take. Blade 4. IRMAA. The Medicare surcharge nobody sees coming. Here is the part they really hide. IRMAA stands for Income-Related Monthly Adjustment Amount. It is a surcharge added to your Medicare Part B and Part D premiums when your income crosses certain thresholds. For a married couple in 2025, the first IRMA bracket kicks in around $206,000 of modified adjusted gross income. For a single filer, $103,000, cut in half, again. So Margaret, with her $98,000 of taxable income, is sitting just below the first IRMA cliff. One Roth conversion, one big RMD year, one capital gain from selling the house, and she crosses it. The moment she crosses it, her Medicare premiums can jump by $70, $170, even $400 a month, per person, for 2 full years before it resets. That is Blade 4, the Medicare ambush. Blade 5, the 9-month estate tax window and the step-up confusion. This is where the title of this video comes from. This is the 9-month clock. When your spouse dies, the IRS gives the estate exactly 9 months to file Form 706, the federal estate tax return, if the estate is large enough to require it. That window also governs critical elections. The portability election that lets you carry over your deceased spouse's estate tax exemption. The qualified disclaimer deadlines. The alternate valuation date for assets. Miss the 9-month window and you lose elections worth hundreds of thousands of dollars. Permanently. But here is the deeper trap. Under IRC Section 1014, assets owned by the deceased spouse get a step-up in basis at death. The cost basis resets to fair market value on the date of death. That step-up can erase decades of capital gains taxes. But, and this is the part nobody explains, it only applies to the half of jointly held assets the deceased actually owned. In non-community property states like Ohio, you only get a half step-up on the brokerage account. In community property states like California or Texas, you get a full step-up on the whole thing. Same family, same death, different state, 6-figure difference. Florida retirees, listen up. Ohio retirees, listen up. California and Texas retirees, you have a hidden advantage you may not even know you have. 5 blades, filing collapse, deduction cut, RMD crossfire, IRMAA cliff, 9-month window. Stack them on top of each other and you get a 60% effective tax detonation on the largest account in the household. 60% of your spouse's life's work. This is the trap. This is the crime scene. This is what nobody warned you about. And now we have to ask the question that will make your blood boil. Who built this? And why has nobody told you? Here is the part that should make you furious. The widow tax trap is not an accident. It was built, brick by brick, statute by statute, and every single party who could have warned you has a reason to stay silent. Start with the IRS. The IRS loves the widow penalty. It is a revenue machine. Pre-tax retirement accounts, the 401k, the traditional IRA, the 403b, are the single largest pool of untaxed money in America, trillions of dollars. And every one of those dollars has the IRS's name written on it in invisible ink. The longer you delay withdrawals, the bigger the eventual tax. The Secure Act of 2019 and Secure Act 2.0 in 2022 made it worse. Congress shortened the inherited IRA payout window to 10 years for most non-spouse beneficiaries. They knew exactly what they were doing. They were accelerating the harvest. The state is not neutral either. States like Ohio, Pennsylvania, and New Jersey layer their own income tax on top. Estate recovery programs quietly claw back Medicaid spending from the home after the second spouse dies. Probate courts in some states take 3 to 7% of the estate just to process the paperwork. Now look at your financial advisor. Most advisors are paid a percentage of assets under management. The bigger your 401k, the bigger their fee. Telling you to drain it through Roth conversions before your spouse dies means a smaller account, a smaller fee, and a smaller paycheck for them. The incentive structure is upside down. Nobody told you this because nobody gets paid to tell you this. Your CPA? Your CPA files last year's return. Your CPA is not a planner. Your CPA looks backward, not forward. By the time the CPA sees the widow's first single filer return, the trap has already closed. Your estate attorney drew up a simple will 20 years ago and never called you back. Trusts, beneficiary audits, portability elections, disclaimer planning, those require ongoing work and ongoing fees, and most middle-class families never get that conversation. And Congress? Congress will never fix this. Because the widow penalty quietly funnels tens of billions of dollars a year into the Treasury without ever showing up as a tax increase on anyone's campaign ad. It is the perfect political weapon. Invisible, automatic, self-executing. This is the system. This is the silence. This is why Margaret was sitting alone at her kitchen table holding that certified letter. But you are not Margaret, not yet. And in the next few minutes, I am going to hand you the defense manual. Pause for 1 second. I need you to do 3 things before we go into the defense plan. Because the defense plan only works if you are still here when I give it to you. Number 1, save this video. Right now. Bookmark it. Add it to a playlist called Retirement Survival Manual. You are going to need to come back to this. The 5 blades, the numbers, the 9-month clock. This is your archive. Number 2, send this video to one married couple today, not next week, tonight. One couple over 60, one brother-in-law with a 401k, one neighbor who just retired. The widow penalty only ambushes the people who never saw it coming. You can break that chain for one family with one text message. Number 3, drop your field report in the comments. I need to know who is watching. Tell me your age, your state, your filing status, and the size range of your largest pre-tax retirement account. Under 250, 250 to 500, 500 to $1 million, over $1 million. That is it. No names, no specifics, just the field report. The comment section is the field hospital. We build the map together. Now let me show you the defense. Listen carefully. This is the part you came for. This is the part you saved the video for. There are 4 moves. 4. If you do these 4 moves while both spouses are still alive, while the joint filing status is still protecting you, you can diffuse most of the widow tax trap. Skip them, and the certified letter is coming. Move 1. The Roth conversion ladder. Start now. This is the single most powerful move in the playbook. A Roth conversion moves money from a traditional pre-tax IRA or 401k into a Roth IRA. You pay the income tax now, at today's married filing jointly rates, in the 12 or 22% bracket. Once converted, the money grows tax-free forever. No RMDs, no widow bracket collapse, no IRMAA pressure, nothing. Here is the strategy. From the year both spouses retire until the year the first one turns 73, you have a window. That window is your conversion runway. Convert as much as you can each year, but stop at the top of the 22 or 24% bracket. Do not punch into 32. Do not trigger an IRMA cliff. Use a CPA to calibrate every December. For the Holloways, converting $100,000 a year for 8 years would have moved $800,000 of Frank's 401k into a Roth. Tax cost? Roughly $176,000 spread over 8 years at joint rates. Future tax saved by Margaret as a widow? Over $400,000. The conversion is the drain. The Roth is the safe. Move 2. The spousal beneficiary election and rollover timing. When your spouse dies, the surviving spouse has options the IRS will not explain. You can treat the inherited IRA as your own, or you can leave it as an inherited IRA. Each has different RMD rules and different access rules depending on age. If the surviving spouse is under 59 and a half and needs the money, Leaving it as an inherited IRA avoids the 10% early withdrawal penalty. If the surviving spouse is older and does not need it, rolling it into their own IRA delays RMDs and gives more conversion runway. Get this wrong and you trigger taxes you did not have to pay. Get it right and you buy years of additional planning time. Move 3. The beneficiary form audit. This one takes one afternoon. It is the highest return on time you will ever earn. Pull every account: 401k, IRA, Roth, pension, life insurance, annuities, HSA, brokerage transfer on death. Check the primary beneficiary and the contingent beneficiary on every single one. Make sure the surviving spouse is the primary. Make sure the children are contingent. Make sure no ex-spouse, no dead parent, no forgotten name from 1994 is still listed. A wrong beneficiary form overrides your will. It overrides your trust. It overrides everything. People have lost six-figure accounts to an ex-spouse because they never updated a form they signed at a job orientation 40 years ago. Audit every form. This year, before December. Move 4. The step-up basis maximization. Under IRC Section 1014, assets owned by the deceased spouse get their cost basis reset to fair market value at death. That step-up can erase decades of capital gains taxes. Here is where state law matters. In community property states, California, Texas, Arizona, Washington, Nevada, Idaho, Louisiana, New Mexico, Wisconsin, both halves of jointly held property get a full step-up when one spouse dies. Full step up. In non-community property states like Ohio, Florida, and New York, only the deceased spouse's half steps up. The other half keeps its original basis. That means a California couple with a brokerage account worth $800,000 and a cost basis of $200,000 sees the entire basis reset to $800,000 at first death. Sell the next day. Zero capital gains. The same couple in Ohio sees only half reset. They owe capital gains on $300,000 of growth. That is roughly $45,000 to $60,000 in federal tax alone. If you live in a non-community property state, talk to an elder law attorney about a community property trust. Tennessee, Alaska, Florida, Kentucky, and South Dakota allow non-residents to establish them. It is a legal hack hiding in plain sight. Roth ladder, rollover election, beneficiary audit, step-up maximization. 4 moves, done in the right order, before death, not after. This is the defense. This is the manual. Save this video. Now let me show you the math that should make every retiree in America sit up straight. 2 Margarets, same husband, same death date, same $940,000 401k, same Ohio kitchen table. One difference. One did the 4 moves, one did not. Margaret with no plan. Frank dies in January. The 401k rolls over intact. Margaret files jointly that year. Starting next year, she is a single filer. Her standard deduction collapses. Her bracket compresses. Her RMDs stack onto one return. IRMAA hits her 2 years later. Her federal tax bill climbs from $12,000 a year to $19,000, then $23,000, then $27,000 as the RMD percentage compounds. Over the next 15 years of widowhood, Margaret pays roughly $310,000 in additional federal income tax that she would not have owed as a married couple. Add Ohio state tax, add IRMAA surcharges, add the lost step-up on the brokerage account. Total damage, approximately $420,000. Vaporized. Just because Frank died first. Margaret with the plan. Same Frank, same death. But starting at age 65, the Holloways began a Roth conversion ladder. 8 years, $100,000 a year. By the time Frank died, $800,000 was sitting in a Roth IRA in Margaret's name. Tax-free. No RMDs, no bracket collapse exposure. The beneficiary forms were audited. The rollover election was timed correctly. The brokerage account was titled through a community property trust set up in Tennessee. Margaret's tax bill in widowhood? Roughly $13,000 a year, almost flat. IRMA never triggers. The Roth grows untouched for her heirs. Total tax saved over 15 years of widowhood, roughly $410,000. Same family, same death. 4 moves, $400,000. That is the ROI of one afternoon of planning. That is what nobody is telling you. Listen carefully. The clock is already running. It started the day you got married. You just did not know it. The Roth conversion window closes the moment one spouse dies. The married filing jointly bracket, that wide, generous bracket that lets you move money cheaply, disappears overnight. The step-up election window is 9 months. The beneficiary form on that 401k at the old job, it cannot be changed by a widow at a kitchen table. It had to be changed while both signatures were still possible. Every move in the defense manual has one thing in common. Every single one of them must be done before. Before the diagnosis, before the stroke, before the fall in the driveway, before the phone call from the hospital, before the funeral, before the certified letter arrives. You do not get to plan after. Picture the timeline. The average widow loses her husband in her early 70s. The average Roth conversion ladder takes 5 to 8 years to deploy without triggering IRMAA. Do the math. If you are 65 right now and you start tonight, you might finish in time. If you are 70 and you start next year, you are already cutting it close. If you are 73 and you have not started, the window is closing fast. The IRS is not coming after you with sirens. The IRS is coming with patience. A 9-month countdown, a certified letter, a number on a page that erases 60% of your spouse's life's work. Do not wait for the diagnosis. Tonight, not next month, not after the holidays, tonight. You made it to the end. That tells me you are serious. So I am going to be serious with you. Do these 6 things right now, not later, right now, while the screen is still in front of you. 1. Smash the like button. Every like pushes this warning to another retiree before the funeral, not after. 2. Hit subscribe. This channel exists to warn middle-class retirees about traps the system hopes you never see. 3. Flip the bell to all notifications, because the next trap I expose might be the one with your name on it. 4. Save this video to your private library. Title the playlist Retirement Survival Manual. Come back to it. The 5 blades, the 4 moves, the 9-month clock. This is your archive. 5. Send this video to one married couple tonight. One brother, one sister, one neighbor, one friend from church. The widow penalty only ambushes the people who never saw it coming. You break the chain for one family with one text message. 6. Drop your field report in the comments. Age, state, filing status, largest pre-tax account range. The comment section is the field hospital. We build the map together. And here is the line I want you to carry with you when you close this video. The IRS is patient. Your spouse is not immortal. The clock is already running. Empty the account before the funeral, or the funeral will empty you.